What if I told you the US tax system doesn't actually punish spending? It rewards the right kind of spending. Every year, millions of Americans work harder, earn more, and then watch a bigger portion of their income disappear to taxes. But at the exact same time, the wealthiest individuals and businesses are doing something completely different. They're not just earning money, they're spending strategically and using the tax code to legally erase massive tax bills. Right now, new tax rules have quietly unlocked 100% tax write-offs on things like vehicles, equipment, real estate, manufacturing facilities, and even research and development. Not partial deductions, not spread out over decades, 100%. And here's the real problem. Most people have no idea these rules exist, let alone how they work. So while everyday taxpayers focus on income, the ultra-wealthy focus on timing, structure, and purchases. This video is not about loopholes. It's not about cheating the system. It's about understanding how the system actually works and why the tax code rewards those who know how to read it. So if you want to see how spending can turn into leverage, like the video, save it, and stay with me, because this changes everything. So what actually changed? Because here's the truth. The tax system didn't suddenly become generous by accident. These changes were deliberate. Under the latest tax law, several powerful rules quietly came back or were expanded, including 100% bonus depreciation, 100% expensing for certain research and development costs, 100% deductions for qualifying production buildings. Now, that may sound technical, but the idea behind it is simple. In the past, when a business bought something expensive, a vehicle, equipment, or a building, the IRS forced that deduction to be spread out over many years, 5 years, 7 years, sometimes even 39 years. So even if you spent the money up front, the tax benefit came slowly. That's no longer the case. Under these new rules, many purchases can now be fully deducted in the same year they're bought and placed into service. Not half, not over time, all at once. This matters because taxes are not just about how much you make. They're about when income and deductions happen. And here's the key point most people miss. These rules weren't designed to help people consume more. They were designed to encourage investment, productivity, and economic growth. The government wants businesses to buy equipment, build facilities, innovate, hire, and expand operations. So instead of giving out checks, the tax code does something smarter. It rewards the behavior first, then gives the tax benefit after. That's why the people who understand these rules don't wait until tax season to think about taxes. They plan before they spend. And once you understand that shift, you stop seeing the tax code as a punishment and start seeing it as a playbook. Next, let's talk about the first and most misunderstood strategy, 100% vehicle expensing. Let's start with one of the most talked about and most misunderstood tax strategies, business vehicles. Most people already know this basic rule. If you use your car for business, you can deduct part of it on your taxes. That's not new. What is new is how far that deduction can now go. Under the updated tax rules, if a vehicle is used more than 50% for legitimate business purposes and placed into service after January 19th, 2025, you may be able to write off 100% of the purchase price in a single year, not spread out, not partially, all at once. Now, here's where the details matter. The IRS separates vehicles into two broad categories. First, passenger automobiles, generally vehicles that weigh under 6,000 pounds. These often come with deduction limits, even with bonus depreciation. Second, heavier business vehicles, those weighing over 6,000 pounds. And when a vehicle crosses that threshold, many of those limits disappear. That's why you'll often see business owners using large trucks or SUVs, not because of luxury, but because of tax treatment. But this is where I need to be very clear. This deduction is heavily scrutinized by the IRS. You can't just buy a vehicle and call it a business expense. You need a legitimate business purpose, proper documentation, mileage or usage records, and real business use, not excuses. This strategy is powerful, but it's not casual. Think of it this way. The tax code is saying, if this vehicle helps you produce income, serve customers, or operate your business, we'll help you pay for it. And that's the incentive. Used correctly, vehicle expensing can be one of the fastest ways to reduce taxable income. Used carelessly, it's one of the fastest ways to get audited. Next, let's move on to something even broader. Equipment and machinery, where the opportunities get even bigger. Now let's move to a category that affects almost every business, equipment and machinery. For many companies, equipment isn't a luxury. It's a requirement to generate income in the first place. Think about it. Contractors need tools. Restaurants need kitchen equipment. Medical practices need technology. Creators need computers, cameras, software, and systems. Under the old tax rules, when you bought equipment, the IRS forced you to play a waiting game. You had to spread that deduction out over several years. So even though the money left your bank account immediately, the tax benefit came back slowly. That's changed. Under the current rules, many equipment and machinery purchases can now be 100% deductible in the year they are purchased and placed into service. That means if a business spends $100,000 on equipment this year, it may be able to deduct the entire $100,000 this year. And here's a detail that almost no one talks about, but matters a lot. The deduction isn't just the sticker price. It includes delivery fees, installation costs, sales tax, setup and configuration expenses. All of that gets rolled into the asset's total cost, or basis, and can qualify for full expensing. So the real deduction is often larger than people expect. Now pause for a moment and think strategic. If a purchase helps your business operate more efficiently, increases your ability to earn income, and reduces your tax bill at the same time, that's not just spending money, that's using the tax code as a force multiplier. This is exactly how experienced business owners think. They don't ask, can I afford this equipment? They ask, does this purchase make my business stronger and more tax efficient? When the answer is yes, the decision becomes much easier. Of course, timing still matters. The equipment must be purchased and placed into service correctly, and it must have a real business purpose. But when done right, equipment expensing is one of the most straightforward ways to turn growth investments into immediate tax savings. Next, we're going to step into an area where the numbers get even bigger: real estate improvements and cost segregation. Now, this is where things start to scale: real estate improvements and property purchases. If you own rental property or commercial real estate, this section matters more than almost anything else in this video. Traditionally, real estate deductions were slow, very slow. When you made improvements, things like appliances, flooring, furniture, or landscaping, the IRS required you to depreciate those costs over 5, 7, or even 15 years. So if you spent $50,000 improving a property, you might only get a $10,000 deduction each year. But under the current rules, many of these improvements can now qualify for 100% expensing in the year they are purchased and placed into service. That same $50,000 improvement, it could now mean a $50,000 deduction up front. And it doesn't stop there. A wide range of improvements may qualify, including appliances and fixtures, flooring and cabinetry, fencing and landscaping, drainage systems and site work, lighting and ceiling fans. Now let's take this one step further. What if you're not just improving a property? What if you're buying an entire building? This is where a strategy called cost segregation comes in. A cost segregation study breaks a property into its individual components and identifies which parts qualify as shorter life property: 5, 7, or 15 years instead of 27 or 39. Once those components are identified, you can apply accelerated depreciation, including 100% expensing to those portions. The result? Large, front-loaded deductions. Some investors use this strategy to dramatically reduce their taxable income, sometimes even close to zero, while still collecting rent, generating cash flow, and benefiting from long-term appreciation. This is why experienced real estate investors don't just ask, what did I buy? And they ask, how is this asset treated by the tax code? Because in real estate, how deductions are timed can matter just as much as how much income the property produces. Next, we're going to look at a rule that almost no one is talking about yet: 100% write-offs for manufacturing and production facilities. Now let's talk about one of the most powerful and least talked about changes in the tax code: manufacturing and production facilities. Historically, even if you built or purchased a facility used for production, the building itself had to be depreciated slowly, often over 39 years. That meant massive capital investments with very slow tax relief. That rule has now changed. Under the new law, if you build or acquire a qualifying production facility, you may be able to write off 100% of the building's cost in the first year. Let that sink in. Not just the machines inside the building, not just the improvements, the building itself. This is something we've never really seen before at this scale. For manufacturers, food processors, industrial operators, and businesses with physical production processes, this can mean millions of dollars in immediate tax deductions. But, and this is important, this benefit comes with strict rules. To qualify, the property must be primarily used for production activities. You must be an owner-user, meaning you can't lease it out. And there's typically a 10-year commitment requirement. This is not designed for casual real estate investors. It's designed for businesses that are expanding operations, bringing production onshore, investing in long-term productive capacity. And that tells you something important. This isn't just tax policy, it's economic policy. The government is signaling that it wants more domestic production, more manufacturing, and more real assets being built inside the US. So instead of subsidizing activity after the fact, the tax code is doing something more direct. It's saying, if you commit capital to real production, we'll dramatically reduce your tax burden up front. For the right businesses, this can completely change how expansion decisions are made. And for those who understand it early, the advantage is significant. Next, we'll cover the final major category, one that applies not just to manufacturers, but to innovators, tech companies, and even small businesses, research and development. Now let's talk about one of the most powerful and most misunderstood areas of the tax code, research and development. When most people hear R&D, they picture scientists in lab coats or massive tech companies burning millions on experiments. But the reality is very different. Under the tax code, R&D includes any activity aimed at developing or improving a product, a process, a technique, a formula, or software. That means R&D applies to far more businesses than most people realize. Manufacturers refining workflows, software companies improving code, e-commerce brands testing new systems, even small businesses experimenting with better ways to deliver services. Under the updated rules, businesses may now be able to expense up to 100% of qualified domestic R&D costs in the year those expenses are incurred, not amortized slowly, not spread out over time. Expensed immediately. And here's where it gets even more interesting. On top of expensing those costs, businesses may still qualify for the R&D tax credit, which can provide an additional tax benefit, sometimes up to 20% of qualified research expenses, depending on the situation. So in some cases, the same activity can generate a full deduction and a separate tax credit. That's a powerful combination. But just like the other strategies we've covered, this one is not automatic. To qualify, the work must involve a level of technical uncertainty, aim to improve performance, functionality, or efficiency, be properly documented. This is where many businesses fall short, not because they don't qualify, but because they don't track their activities correctly. The bigger picture here is important. The government wants businesses to innovate, improve productivity, and stay competitive. So instead of guessing which industries will win, the tax code rewards the process of innovation itself. If your business is actively trying to build something better, even if it's incremental, the tax system may be designed to support that effort. And when you combine R&D expensing with the other strategies we've covered, the impact can be dramatic. Now let's bring everything together and talk about the strategic lesson behind all of this. What you've seen in this video isn't a collection of tricks. It's not about loopholes, and it's definitely not about cheating the system. It's about understanding a simple truth. The tax code is a set of incentives. When businesses buy equipment, invest in real estate, build production facilities, or develop new products, the government wants that activity to happen. So instead of rewarding it later, the tax system rewards it up front. That's why the biggest difference between average taxpayers and strategic ones isn't income, it's planning. Most people think about taxes after the year is over. Strategic taxpayers think about taxes before they spend a dollar. So here's the real question I want you to think about. Are you making financial decisions based only on price? Or are you considering how those decisions are treated by the tax code? Because the same purchase can be a financial burden or a strategic advantage. The difference is knowledge. Now, a quick but important disclaimer. This video is for education only. Tax rules are complex, they change, and they depend heavily on individual circumstances. Nothing here is personal tax advice, and you should always work with a qualified CPA or tax professional before implementing any of these strategies. That said, understanding how the system works puts you miles ahead of most people. So let me ask you, which strategy surprised you the most? Vehicles, equipment, real estate, manufacturing, or R&D? Drop it in the comments. I read them. If you found this breakdown valuable, like the video, subscribe to the channel, and turn on notifications. On this channel, we don't just talk about money. We talk about how the system actually works, so you can move through it strategically, not blindly. I'll see you in the next one.